Alrighty, today we're going to be talking about concessional and non-concessional contributions into super. Simply put, it's the two different ways that you can put money into super in Australia. Okay, so we're going to go through the main ways that you can actually do this. Now, simply put, you've probably already gathered the real difference between the two words is just one has the word non in front of it. So normally we'd consider concessional contributions as pre-tax contributions and non-concessional as after-tax. So concessional, pre-tax, non-concessional, after-tax, okay? The reason the word non is in front of the word concessional, non-concessional, is it doesn't have a concessional tax rate, okay? So pretty simple when you think about it from that sort of way. Now, with each of these two ways, there's multiple underlying ways the contribution can actually be made. So with concessional contributions, a lot of you, even if you don't realise it, may already be doing it. Okay, and this is employer super guarantee, which is a mandated payment from your employer to your super, which you might be aware is 11.5%. Okay, so let's use John as an example. John earns $100,000 plus super. Typically speaking, unless their employer is really generous and pays extra, they'll just be paying the minimum, which is 11.5%. So John will get an 11.5 grand to his super, 100 grand plus super, so an 11.5 grand to his super. Now, the other type of concessional contribution is salary sacrifice. Okay, this is a voluntary one. So you can voluntarily sacrifice some of your salary to put into super. So this sort of achieves, the old saying, hit two birds with one stone, where you add additional money into your super whilst also saving on tax. Because again, this is a pre-tax contribution. Now, simply put, we'll go into this in a bit more detail later, but just really simply put, a pre-tax contribution into super means it's on the salary. You're not doing it after tax when it hits your pocket. It's before that. It's before your employer takes the tax out and sends it to the tax office. Okay. So hypothetically, if you saw on your pay slip that you got paid, let's say $4 grand a fortnight, okay, and you only saw 2,500 of that realistically after the tax man takes his chip, they'd actually be taking it from that $4 grand amount. So if you did $500 salary sacrifice a fortnight, you'd end up with $3,500 of assessable income. Okay, and then you'd receive whatever that would be after in your pocket. All right. Now, some people don't have the option to do salary sacrifice. For example, self-employed people and these sort of things. So back in the day, people could make voluntary contributions into super and claim it as a tax deduction. Wasn't as well known. It definitely is these days. There's hundreds and hundreds of different videos and podcasts that talk about it. But essentially, when people are talking about making voluntary contributions into super and claiming it as a tax deduction, most of the time they're talking about this third dot point, which is called a personal deductible contribution, sometimes referred to as a PDC. Okay. So personal deductible contributions and salary sacrifice have the exact same outcome from a tax perspective. Okay. Salary sacrifice, you're getting your employer to do the legwork for you, which is where you tell them, hey guys, I want to sacrifice this amount, chuck it into my super, and they'll take care of it. All right. Personal deductible contribution is essentially where you do it yourself. Typically, it's done as a lump sum on an annual basis. So a personal deductible contribution, we'll use an example again with John earning 100 grand. If he's got 30 or 40 grand sitting in his bank account that he's doing nothing with, and he decides, look, I'm happy to put 10 grand of this into super. I know that I can't access it till I'm 60 at the earliest, but I'm happy to put it in there because I want to reduce my tax and add to my super. So he pops 10 grand into a super fund, and then he has to do something. Okay, guys, so don't just pop it in and not do anything. If this is your intention to claim it as a tax deduction, you actually have to notify the fund. And the way you do that is via what's called a notice of intent to claim form. Okay, so let's use John as an example. He puts 10 grand into his super fund as a personal deductible contribution. He notifies the super fund, hey guys, I'm going to be claiming this as a tax deduction via that notice of intent to claim. They'll say, yep, righto, no problems at all. We'll now consider that a concessional contribution. Now, this is a really important part because once they do that, it forms part of a concessional contribution, meaning that it will be taxed at 15% on the way in. Okay, all concessional contributions are. So as an example, when your employer super guarantee goes into your super, let's say $1,000 goes in a month to your super from your employer, and you only see $850 of that, you're thinking, hey, hang on, what's going on there? It's because 15% has been taken out to be sent to the taxman, okay, sent to the ATO. all concessional contributions are taxed at 15% on the way in, all right? So when you look at your super statements and see the tax, it might say contribution tax or whatever it says on the statement, that is that 15% going to the taxman, okay? Now, typically where people will benefit is the difference between only paying 15% on the way in, because again, salary sacrifice and employer super guarantee, pre-tax, all right? The difference between that 15% and their marginal tax rate. So let's say you're on 100 grand and you're paying 30 cents to the dollar to the taxman. That's a difference of 15 cents to every dollar, 15%, all right? So it's a pretty big saving. And for people on those higher incomes, of course, it's going to be more. People on lower incomes may be less, okay? So in the example of John doing that $10,000 personal deductible contribution to super, essentially now, after he's submitted that notice of intent to claim, telling the super fund, I'm going to claim that as a tax deduction, they're going to take $1,500 from it, okay? So 15%, send it to the taxman. Now he's left with $8,500 in his super. Now you're thinking, well, what's the benefit to him if they've taken $1,500? Like I said before, now he'll be able to claim this as a tax deduction. And essentially the easiest way to think about it, how this bit works, is I told you before his income is 100 grand. Now when he claims this as a tax deduction, just like other deductions or tax deductions, it will reduce your assessable income. So now when he goes to do his tax returns, he doesn't earn 100 grand. Because he's put that $10,000 deduction in, now it'll be $90,000, okay? So he'll be able to claim that as a $10,000 tax deduction. So he'll only be assessed on $90,000 of income. So hopefully in this case, depending on whatever else is happening in his life and his personal financial circumstances, hopefully he'll get a nice little tax return, all right? So simply put, concessional contributions is the pre-tax contributions, employer super guarantee, salary sacrifice, and personal deductible contributions. All right. Now, the other type of contribution, the non-concessional, again, after-tax contributions, are just after-tax contributions into your super fund. Okay, so these are contributions for people who want to boost their superannuation balance. People may say, why do people want to do that? Well, obviously you want to retire on a nice balance, but the other thing is that super is obviously a low tax environment, okay? So superannuation is actually only taxed at a maximum of 15% on earnings, okay? So if you've got 100 grand in your super and you get a 10% return, 10 grand, you'd only be taxed a maximum of 15%, $1,500. Whereas if you had 100 grand in your personal name and you made a 10% return, let's say, just hypothetically to make this really easy, a 10% return on a term deposit. I know that's unrealistic, but just to make it easy, that means you get 10 grand back in your pocket. However, now you've got 10 grand of additional assessable income. So if John, for example, in that case, he'd go from earning 100 grand to 110 grand. Now he'll be paying 30 cents to the dollar on that, all right? So some people will put money into super because it's a lower tax environment and they're okay with it being locked away till they're 60, Some people might be 58, so it's not a big deal for them. It's only locked away for 2 years. Some people might be 38, then it's a bit of a different story. All right? So non-concessional contributions are purely after-tax contributions. Now, there's other ways of utilising these non-concessional contributions. One of them is the government co-contribution. So some of you may have heard about this before. Essentially, if you put up to $1,000 into your super, the government will match it up to 50 cents to the dollar, and you can get up to $500 as a co-contribution. Now, you only get this amount if you're earning between a certain threshold. I think the maximum is in the early 60s and the minimum is in the early 40s. Now, if you're below the threshold, you're going to get the full amount anyway. But as soon as you go above that threshold in the 40s, that's when it starts to taper down. So even if you put $1,000, you might not get the full 50 cents to every dollar. All right. Now, the other way, again, these are less relevant for this conversation, but we're just going to quickly talk about it, is spouse contributions. Again, this wouldn't be going into your own super fund, it'd be going into your spouse's, but it is considered a non-concessional contribution either way. The ones we'd focus on for the duration of this video at least will be concessional contributions, which would be super guarantee, personal deductible contributions, and the salary sacrifice. And for non-concessional, purely, we're probably looking at just those after-tax contributions to boost your super. Okay. So by this stage, hopefully you sort of understand what the two are. They are the two main ones, okay? There are other things that don't impact these contributions, for example, downsizes and things like that, but we're not going to talk about it in this video. They're in the other videos. We're just going through the basics today. All right. Now, with both of these types of contributions, obviously there's a cap. Okay. Now, there's a cap in place for a reason, for many reasons. But as you can imagine, if you're an ultra wealthy individual and there's no cap on concessional contributions and you can claim a tax deduction, they'll be chucking all their money into super, bar what they need to live. Now, the cap is $30,000 for this financial year. All right. We're obviously in the 2024-2025 financial year when this video has been made. It may change over time, but at the time of making this video. Now that means essentially you've got a cap of $30,000 per year for concessional contributions. That includes the three we were talking about before. So it includes your employer contributions, okay? That's an important thing to note, and salary sacrifice and any personal deductible contributions. So let's use the example again of John before. If he's on 100 grand and he gets 11.5% super, he's already got over 10 grand going into the concessional cap. All right. And then if you chuck that extra 10 grand in, now we're over 20 grand. Let's just make it for easy maths. Let's just say we've got 20 grand that he's already done with his employer plus his voluntary contribution. So in that example, he's only got $10,000 left over because his cap is $30,000. Generally, everyone's cap is $30,000, okay? Now, where there's a little bit of a caveat there, it's called the carry forward unused concessional contribution, CFUCC, okay? The carry forward unused concessional contribution is for people who have balances in super of less than $500,000, and you just need to make sure you're eligible. Very easy to find out. You can log into MyGov, jump into the ATO portal, click on super, etc., etc. You can figure it out yourself. Now, the carry forward unused concessional contribution allows you to essentially utilize the last 5 years of unused concessional contributions cap. So let's make this really easy to understand, and we're going to make it as basic as possible. Let's just say John, for the last 5 years, had done that same strategy as before. So let's say 10 grand came from his employer, 10 grand came from him personally. And let's pretend the cap was $30,000 a year for the last 5 financial years. It wasn't, but let's pretend. Now, in that example, that would mean each of those years he had $10,000 left over in his cap. So each year, 10 grand plus 10 grand plus 10 grand plus 10 grand plus 10 grand, it means he's got $50,000 over those 5 years that he hasn't used. So in this financial year, technically, from that standpoint, he'd have the $50,000 plus the $30,000 cap for this financial year. Okay, so he's got a total of $80,000. And for some people, that can be a really, really good thing. For example, if they're selling an investment property with significant gains or shares with significant gains, or just have a really high salary and just got a bit of spare money around, they may look to utilize this sort of a contribution to reduce their assessable tax, okay, their assessable income. Now, with non-concessional contributions, they have a cap also, of course, which is $120,000 per year. Okay. Now there is a thing called the bring forward rule, which essentially allows you to bring forward an additional 2 financial years and do a total of 3 of those non-concessional contributions in 1 year, allowing you to do $360,000 in total. Okay. So this is really good for people who are looking to boost their super, might have significant amounts of cash for whatever reason, and looking to put it into super for their retirement, lower tax environment, whatever it may be. Okay. So simply put, just in this video, we've quickly described how concessional and how non-concessional contributions work, the types there are, and also the caps and the associated caps with each of these contributions. There are a couple other videos that I've uploaded which go into more detail for each of those. Okay, so we're going to go into a video which details salary sacrifice, a video which details the personal deductible contributions, but this one was just really general in nature. Okay, so I hope you enjoyed it. Have a couple watches of it. Trust me, watch this a couple times. It'll be drilled into you. It's pretty straightforward. And leave any comments or anything that you'd like to add after the video. Thanks, guys.